Don't pay any more tax than what you absolutely need to on your investments. And in this video, we're going to run through an end of financial year checklist to make sure that you're claiming all the tax credits and all the tax deductions that are available to you for your investment. Now keep in mind, I'm not a licensed tax advisor. This video is for educational purposes only. Now the first item on the checklist is making sure you claim any franking credits associated with any dividends that you've received throughout the year. Simply what a franking credit is, it's that the tax that the company has paid on your behalf on the dividend that you've received. The idea behind this is it limits double taxation. The company has already paid tax on its profits. It then pays some of those profits to you in the form of a dividend. So it then passes on the tax that it has paid to you, and it's called a franking credit. Now, if you use a subscription to track your investments, sometimes they will produce these reports for you. For example, ShareSite. Not sponsored in this video, but as a tool that I use. However, if it's something you want to do yourself, you need to check the statements that you've received from the companies that have paid the dividends throughout the year. Not all companies pay franking credits, so you need to check these statements. This is an example of a statement that includes a franking credit. Now, franking credits are really good because they are refundable tax offset. So this means that if you receive more franking credits than what your tax bill is, then you actually get a refund of those amounts. So it's a really good tax offset. To walk through an example of what this might look like, say you have a $100 dividend, you include the $100 in your taxable income plus the franking credit. You then apply tax to this amount, and then the franking credit, although it's included up the top, is included down below again as an offset, reducing your actual tax liability. Now, if you invest in Australian ETFs, different Australian ETFs, in the tax world, these are called AMITs, which really just means they're managed investment trusts. So you can still receive franking credits from these ETFs, but you'll get this big long statement that includes all the different kinds of profit that you've received from these different ETFs. It won't be as simple as receiving a distribution from that ETF and seeing a clean franking credit attached to that distribution. Now, what's important is that franking credits is fairly unique to Australia. So if you invest in foreign companies from Australia, for example, say you buy Tesla, you buy Disney, any of these companies in the United States, and they pay you a dividend, they won't have franking credits, but what they may have is withheld some tax from that payment to you. The United States wants to tax a little bit of your dividends that you're receiving from these American companies. So they withhold a little bit of a tax, and this is called a foreign income tax offset. And when we compare the foreign income tax offset, the FITO, when we compare that to the franking credits, it's not as good. It still does reduce your tax bill. So if you still have a tax bill and you have some of these FITOs, it will reduce that bill. But if it reduces it below zero, you won't get a refund for the excess. So this is what's called a non-refundable tax offset. Now, one area where people possibly get caught out is dividend reinvestment plans, where you've signed up to one of these plans from a company, and instead of them paying you a dividend, they just issue you more shares. Now, the trick here is for tax purposes, how these are treated are, even if you have signed up for some of these dividend reinvestment plans, how tax treat them is you've received that dividend, and then you use that dividend to buy more shares. So you need to be careful about this and include those dividends in your income. Now, if you're an individual and you buy and sell shares and you make a profit on those shares, generally that's considered to be a capital gain, and you need to include that in your taxable income. Now, if you have held those shares for longer than 1 year, then you may be eligible for the 50% capital gains tax discount, which is really good. So make sure you have some good documentation around when you bought the shares and when you sold the shares to support this discount. Now, if you make a capital loss where you've sold shares and you've received less money than what you bought them for, this is called a capital loss. Now, capital losses kind of suck. You can only use those to offset any capital gains that you have made in the current year or in future years. So if you make a capital loss within an income year and there are no capital gains to offset that against, still disclose that in your tax return, because then you can carry forward that capital loss to future income years. Now, the financial year has already finished, so it's a little bit too late to do this next strategy that I'm going to discuss. But if you have shares in your portfolio and they're just dogs of shares, you know they're never going to come back, or your investment thesis and philosophy has changed for that company such that it's no longer a good investment, then it could be a good idea to sell those shares, realize that capital loss, if you have other capital gains to offset that against. Now, what you need to be careful of is what are called wash transactions. So if you sell shares to realize a capital loss and then buy those shares again the very next day. The tax office doesn't really like that. So you may come into their target area if you start doing those sorts of things. But if you just realize a capital loss, and it's because these shares suck now, they're not going to get any better, and you offset that loss against the gain and don't repurchase the shares in the near future anyway, then that's allowable, that's okay. So I wouldn't recommend selling shares just to realize the tax benefit, the capital loss. Only do that if you've been holding on to these things, you know they're never coming back, and it's time to cut bait with them. The next item on the checklist is claiming any tax deductions that are available to you for your investments. So the big one for this is interest. So if you have borrowed a sum of money, and that sum of money is to purchase shares or purchase items that are going to produce you income, then you can claim the interest on that borrowing as a tax deduction. Other common tax deductions on your investments are things like financial advice that you receive related to your investment, as well as if you have any subscription. So for example, I have a subscription to ShareSite. I pay for that, so that's a tax deduction I can claim because it's related to tracking my investment. Now, one common misconception is that brokerage fees are not normally a tax deduction for individuals. You have to add that in to the cost base of when you buy and sell shares. So it will change your capital gain and it will change your capital loss, but it's generally not available as a tax deduction to individuals. Now, I've made 2 other videos around tax tips for end of financial year. I'll leave a link to those in the description. If you got a bit of value out of this video, if I helped you along, all I would ask is that you give the video a like. It really helps push my video out to other viewers. And if you want to see more content from me, I do videos on everything on how to invest, teaching you how to invest, to how to save money on your taxes, and how to save money on your mortgage. So head over to my YouTube channel and check out some of my other content. Thanks for stopping in. See you in the next video.